Yeah, David, that's right on the recession part, but I also want to focus on this third quarter NABE outlook, suggesting profits and sales are heading to levels that have in the past signaled or been commensurate with recessions. Take a look here. The net rising index, that's what we call the percent increasing minus those decreasing. And this is for sales declined to 20 from 29.6. The index for profit margins coming in at minus 17. That means more companies see declining rather than rising margins, the second negative number in a row, reflecting a challenging environment for companies. Wages and input costs look to be pressuring company bottom lines. Wages are still expected to rise in the next quarter, and material costs and prices charged are also positive, though they're all off their peaks for now. One bit's of good news we got: CapEx and employment plans, they do remain strong. Markets processing the outlook for profits and for a pivot from the Federal Reserve, with the latest Fed speak raising questions about whether there's been some kind of, I don't know what you'd call it, change or alteration in policy. The peak funds rate, though, at 492 this morning, off its high water mark of 503. But hey, that's still pretty high compared to where we were even last month.
We've redefined what a pivot is. We've redefined it from meaning lower rates to pausing to slowing. And if you redefine that, then you will have a liquidity effect. And that's what we're getting. We're getting a liquidity effect rather than a fundamental effect.
Okay, so the chance of a 75 basis point hike, 95% for November, but it's 49%, call it 50 for December. So there's a December debate, but it's not over cuts, it's not over pauses, it's just over whether the pace of hiking is a quarter point higher or lower. That is whether the funds rate ends up going up, I don't know, 425 basis points this year or 450. And some people, Carl, you remember, got pretty excited about that difference on Friday.